I often like to take a moment. I'll tell you, I have a bit of a ritual. One, when my account hits new highs, I often take some time and I read something that will kind of knock some humility into me, like the Great Crash of 1929, something that gets me a little bit more nervous. But I like to reflect on the year that was, take a look at some of the mistakes I made, take a look at some of the things that I did well, and try and avoid what didn't work, where I went wrong, and then take a look at where I went right and how things went. I often find that the trades that are winners are less helpful to me because obviously they went well, the mechanics went well. I know why I was successful. But in the ones that I kind of had blunders in, I like to look at those and reflect on what I was thinking, what went wrong, could it have been avoided, and hopefully won't do it again. So that's a little ritual that I have that I like to do. I suggest doing the same. I would also suggest writing down some goals. Try to be reflective into yourself and see what some of your biggest flaws are, what some of your greatest assets are. I often get DMs from people, and they say to me, Justin, I follow you a lot, and I sometimes, I'm sometimes successful with my trade, I'm sometimes not. Where am I going wrong? And more often than not, I notice it's that people either follow my entry, but they don't follow the exit. Like if, for example, with like Facebook, I was very go bullish until about 128, 130, and I kind of made the call to get out, but people, of course, knew better. Sure, it got an extra 3 points, but it's now significantly lower. A minimum of $10 to $12 lower off of the sale call. So that's one area where I think that that there can be some improvement on as far as people who follow. And then I also notice that people sometimes cut a little too soon. Like they'll ride in a trade, they'll enter a trade, and then they'll kind of be sitting pretty with their like 3-point gain when the real move was the 30-point move. That's also important. I know it's funny, human psychology, and I'll tell you, I read about this, and I've actually I watched a study about this with monkeys a while back. Believe it or not, if I had to redo my degrees again, I probably would have continued on with the finance degree, but I would have probably, instead of double majoring in finance and marketing, would have double majored in finance and psychology, because I think that psychology plays into everything we do in life, particularly in trading. So what I mean by that is when you look at the market, it's all a bunch of people making decisions, and in many cases you're playing against the hopes and fears of other traders. Their hope of prices either going higher or lower, or their fear of prices going higher and lower. And the example I gave, to come back to where the purpose of this this discussion, was that people often are hopeful when they're wrong and fearful when they're right. What does that mean? How can that be? So here's the example. You get into a trade correctly, let's say XYZ stock. Let's use NVIDIA because that's a really popular one, so it kind of brings it home. You watch the stock go from 60 to 70. You're still bullish. At about 80, you start getting nervous, and let's say you pull the trigger to get out. Then you watch the stock go to 90, and then 100, and then 110. The point being is that, and that's an example, you did make some good money on that, but you left so much on the table. And I think it's really because people get fearful that they're going to lose their gains. So is that right or wrong? My answer to that is this. It's probably a little less straightforward, or I shouldn't say straightforward, but it's probably a little less cut and dry than other people might give you. My answer to that is I like taking profits along the way. You'll often see, I'll say trim and trail. That means trim the position. Like let's say you have 500 shares, take off 250 or take off 500 or whatever. I'm sorry, in this instance, take off 250 or 300, out of the 500 base. Sorry, I was thinking 1,000 shares. But the point is that you get nervous that you're going to lose the gains that you already have. And my answer to that is this, is that if you're right, if you've entered correctly and you're making money, yes, take some profits along the way, but don't get afraid if you lose some of that, because the goal is to really let the winners run. What I find, and then the other end of that psychology is that let's say you enter a trade and it goes wrong right away, people are like, oh, it'll come back, maybe it's not down that much, I'll give it a little bit more time. No. You should be very fearful that, and I'm not saying that don't give your trades an opportunity to work. It's important to have a defined stop when entering a trade that gives you the opportunity to make money, that you don't get stopped out right away. Only, like, let's say you buy it, the stock is down 50 cents, and then it goes kiting up $10. You didn't set your stop properly. Like I often talk about a right or right out trade off of trend or off of a 61.8 or so on and so forth. You got to give it a little bit of room. Somebody was just asking, how do I calculate the stop? So that's a good question. When I enter a trade, I tend to like to have a 3-to-1 ratio, meaning I look to make $3 for every dollar I have at risk, and I always reevaluate that as a stock goes higher. The example I gave a few weeks ago that I think really paid off well was Wynn. I was in the stock, and I had said that we would see, I think it was 96 or 97, and I said I thought it was going to go to 103. And I had and it did. It went up, and then it pulled back promptly, and a few people were like, oh, I got trapped in the stock. I was waiting for 105. Another example of when I say to get out, and then they don't listen to me. Anyway, so they got lucky. It did go to 105. But then there was some news they came out, and the stock is back down in the 80s. I mean, the thing got absolutely slammed. And we were totally, disavowed the trade at that point because we were already out. The sell call was in at 103. But the point being was that I was noticing the risk reward was shifting to me when we got up to 103. That was it was a resistance level. It wasn't an arbitrary level. It was where there was some past resistance, or it was a fib level or a reference high. But for me, the risk reward there, I was risking, in my view, the pin for the stock to pull back from 103 to 100, or to go up another $2 to the let's say to the 105 from the 103. Which was also a reference level. So there I was risking 3, or could either do it the American way, the 3, or if we're going to be in Man in High Castle, the German 3, risking 3 to make 2. And that to me became an asymmetric situation, and it was time to go. So I not only when I enter a trade am I risking, let's say, $1 to make, or risking $10 to make 30, like let's say in Priceline or something, a big stock or like a Google. But I like to keep that ratio roughly there. If I'm really struggling for plays, like if we're in a really dull market, once in a while, I'll make the exception of risking 1 for 2. In many instances, I will just wait. Waiting and being patient and kind of being more the sniper than the amphalotic fire pays off better. I'm always waiting for my setup. And honestly, I've said in the past, I've unrelated to trading, but other business lines that I've been in, that I often find I do more passing than an NFL quarterback. Knowing when to say, I'll tell you this, in my experience in life, and I'm not that old, I'm 38, that more often than not, knowing when to say no is more important than knowing when to say right. To say yes. Knowing when to say no is often more important than knowing when to say yes. And if the setup isn't working, like I often get people who message me and they ask me about a stock, and the chart is and it's usually right before earnings. Sometimes the setup is very clear that it's a long or a short, but most of the time I guess people already can discern that. So they ask me when it's unclear, and I'll tell them if I don't feel like I have an edge, I don't gamble. There's just no reason to gamble. I'll wait until there's a setup that I think I can win. It's like the example I give in my risk management video that I borrowed from Jesse Livermore. Like if I go to the horse races, and this I think, or a dog race, I can I can probably do some research and pick one or two races of the day that I can win, I can beat. You know, the jockey or the breeder, or the conditions match up for a dog. But it would be ridiculous for me to say that I could go to the track, take the race sheet, and pick every single race and be a winner. It would be a fool's errand. And I think a lot of people make the mistake of thinking they have to participate in every single play. Just wait for the ones where you have an edge and that you think you could win, and those are the ones I'd rather have bet heavy on, like 2 races that I think I could win, than go in and think I can beat the whole race sheet. Same thing, like for an example, if you go to a casino and you're playing roulette, your best bet, as crazy as this sounds, is to go in and bet red or black, all of it at once, and win or lose, you walk, because that's the highest probability of the game of the night. Playing over and over again, 0 and double 0 take down your average over time. I could go on and on with this with chance games. I actually am very well versed in statistics and probability. That's also, by the way, something if you want to up your ante, do some work on some statistics and probability. It sounds boring, but it's actually rather interesting. There are very entertaining ways to learn it, particularly with chance games, gambling. Anyway, back to what I was saying. So yes, risking one, like for example, when I take a trade entry, if I have, and this is always this is rare that you get it, but let's say you get a trend line touch, a gap fill, and a 61.8 Fibonacci retracement all at once. Go in heavy on that trade because it's got multiple lines of theses for the trade. So let's say a stock is coming from an old all-time high, not even a lower high, and it's down to a 61.8, sharp, fast, right into trend, right at a gap fill. You might want to bet that a little bit more heavy than you would than if it came from a lower high, or if there wasn't a gap fill and it was just the trend and and a moving average. The more ducks you can line up for the probability of your trade to be successful, the better. The less you have, the less you want to play. I think another mistake I see people make that I get messaged with is that people think that they have to be, it's all or nothing. And I'll tell you, this is like very personality gauged wise. Let's say you have a stock and you buy into it and you're feeling a little iffy about it, or it's run up a lot. Just take half off or a quarter off. Bring your size down. Sell down to the sleeping point. That's the gauge. Like if you're up all night worried about every tick, you're probably, first of all, you're probably positioned wrong, and number 2, you're probably too big. Your size is too big. I know in my instances, if I'm ever worrying about a position I'm in, I need to usually to get out of it. I'm either being stubborn or my size is too big. I like to have as many factors in my way as possible. So that's the story. Let's get into, that's a little bit of trading psychology. I don't know if you guys want to continue on this line or if you want to get more into the specifics of the markets. If you type along, you could write markets or psychology, and I'll do a eyeball test, and we'll go the way of that. I'm going to try and do about maybe 10 more minutes of video. So, let's see. All right, we could get into some of the markets. People seem to want to discuss specific instances. All right, so let's do that. We could do another psychology video in the future. I might actually do a specific for that. I have a couple of pre-prepared names, and then I have some of the ones that you guys want to talk about. First and foremost, I see a really great setup for tomorrow, and I hope it triggers tomorrow. It might not. We might have to wait till next week. But if you look at the ES, remember I said I'm looking at the cash, meaning SPX, and the ES, because the SPY went ex-dividend the other week, and the levels are a little bit off. So we had something today that was quite unique. We have a doji after a big kind of a big down bar, and we held the 20. Remember, I've said that if we lose 10 days, we get 20 days, and then we reassess. So today we had what I would consider a look below and a mini look below and fail of the Fed day range. The Fed day low in the ES was 22.43. We got below there. In the morning, there were a couple of quick little attempts to get below there. Then we finally got below there and then just came back up. And I'll tell you, I was watching the tape today. A couple of things I noticed, and this is important. I would suggest this to anyone who's trading. Learn how to read the tape, how to get a feel for things. I was saying that I thought that the tape looked a little weak, but I didn't see the internals cooperating for there to be a real sustained move below the Fed day range. How did I know that? One, the NYSE and the NASDAQ were green initially when the move started happening. Then it got to be like just below -1 and then like just below 2-1. This isn't like sustained bare breath, like 5-1 negative or 8-1 negative. Even 3-1 negative I thought could have been more sustained today. Then I was watching the breadth vacillate between positive and negative, and then I started seeing tick divergence. The market was making new lows, and the ticks weren't making new lows, and it just didn't look right to me. And my question was, what were the bears waiting for? You know, they're all bared up. You know, there's supposed to be this big pension fund selling. It didn't materialize, and we wound up closing back into range. So when you look below the range and you close back in the range, it's a look below and fail. 2 setups tomorrow. And this is the brilliance of being able to observe these things, because you don't have to gamble on which one is right or not. Above today's high, I'll say this, when you have a look below and fail, and then you get above the day's high of the look below and fail bar, the probability, and it could happen where it doesn't happen. Nothing is 100%. If you get above today's high tomorrow, the chances are we will rally to the top of the range again. The waypoints would be the Fed day VWAP, which is 22.59 and the range high is 22.72 So that is the story. Someone just asked about the volume. This is some of the weakest. I mean, I've seen summer Fridays with more volume than this, like in the dog days of summer. This thing is an absolute mess. It's like a paper cup. You can, like, honestly, if me and like a couple of friends got together, we probably could take the Dow over 10,000 at this point. That's how light the volume is. So yes, that is to be taken into account. It's a bit of a paper cup. But I will say this, when you have a look below range, the same thing with the top of the range. When you have a look above and fail, you tend to rotate to the bottom end of the range. When you have a look below and fail, you tend to rotate back to the top of the range. So I like tomorrow or a trade Monday or whenever it happens, over today's high long for a right or right out trade. Tomorrow or Monday, Monday is closed, so Tuesday. Yeah, that's right. The markets are closed another long weekend. They reopen on January 2nd. So sometime tomorrow or on January 2nd, if we were to get below today's low, I like it as a right or right out short, because now you look below range, you tested back into range, and now you're back below range. It means prices are now accepting lower. Today they rejected being lower and they came back where they were comfortable. So that's the 2 setups I see. Long over today's high, the doji high, or short below the low for continuation lower. So a lot of my overall market bias will be contingent upon the Fed day range. I kind of treat Fed days almost like earnings days. If you watch me in the stock, I often say I either like it above the earnings day high or short below the earnings day low. The Fed days to me, and ECBs are kind of like Fed day lights. So after you've had a Fed day and then there's an ECB day, you could kind of supplement it. So that's how I look at it, that you can play against the Fed day ranges. They're very, very important. And today was a look below and fail of the Fed day range. NVIDIA, the curious case of NVIDIA. So this is one that I have discussed. I had so many people. I had said I was very bullish on this stock. I did say I thought we were getting a little bit long in the tooth, and you had something very cute happen. Citron Research, Andrew Left, who's a famous short seller, who really I think may have ruined Bill Ackman's career by the value exposing Valiant. But the point being is he didn't make Valiant go lower. He exposed a thing that was already there, an issue. He brought it to light, and the weight of the problem in the company is what collapsed the stock. So he came out, and I think he had been shorting, I guess trying to top pick in NVIDIA. Based on the interview, it sounded like he was a little underwater, and I think he knew in a low volume week with getting TV airtime that he probably could knock the stock down a peg or two. And yesterday's move was an outside reversal day, and then today we opened lower, and the stock actually wound up closing green. His thesis of the short had nothing more to do, there was no fraud, there was no nothing other than he thought the stock was too expensive. It had run too far too fast, and he was basically looking for it to come back to a key area, actually the backside of the old up channel. So my theory on this is that stocks peak out of, or I should say stocks run or sell off more than people think are reasonable than at the beginning when they enter, out of necessity, not necessarily because of rationality. Let me explain first and foremost. I know a lot of people here are retail. They've never worked at big trading firms. But the way big firms trade is that they have very, very large size, often percentages of the companies. And because you and I can sell 100 shares or 500 shares or 1,000 shares or 10,000 shares, we can probably be in and out of that trade in, I don't know, a couple of minutes or seconds. Not so when you have that large of a size, because our selling couldn't depress really the price other than maybe a couple of cents but these guys have millions of shares and they could depress the price significantly. So let's say the long institutions in NVIDIA want to average $100 in the stock. They can't just start selling it at $100 to get out at that average price. So what do? They mark it up much higher. And then what they do is they will keep marking the stock up until their incremental buying can no longer move the price, meaning there's no more people willing to pay higher. And what they'll do is they'll sell their shares out on rallies on the way down. Everyone has missed that run, and they're now thinking because it was high before and it's down a little bit that they can buy in. And they don't necessarily realize that the move is really over. So that is, at least for a while until we get into, supports and things like that. But that's the way institutional traders trade. And I think that most people don't understand that. That's a very important concept. So that's why when you see things, go completely vertical, it's all the shorts capitulating at once, it's all the chasers getting in at once, and that big volume expansion gives the institutions the volume and the excitement, the carnival circus that they need to be able to rotate out of the size that they're in. So that's the way. That's really the way the market works. So the same thing on the way down. The crescendo at the end, the complete give up. The stock is going to zero. It's everyone downgrades it. Where were they 40, 50 points ago? No. It's now. After a stock has been cut in half, now's the time to downgrade, and that's usually the bottom. So that's the way it works. Markets move to extremes, and I think that he thought he would be able to influence that process. Whether he will or not, who knows? Was that the peak of NVIDIA? Who knows? But today's price action to me says that maybe it's not. My thesis was that we probably have a few days of pullback. And it would be similar to like when Carl Icahn got out of Netflix. They had this big earnings move. The stock was already up huge. It pulled back a bunch of days, and then it just took off, and it went even still higher. So I like Nvidia. I think it is high. I don't necessarily know that it's time to like first pile in that it's cheap, but if I were long, I probably wouldn't have panicked out on Left's comments because, yeah, he's a talented analyst, but he didn't have any reason to be shorting other than he thought the stock was too high, and I think he was trying to game the mechanics of the market. So that's the story. Until the 20-day moving average breaks with conviction on this, I think you could probably stick with it. Today's range was sort of the bounce back. If you're looking for a quick play, I think you can play long over today's high or maybe a quick short below the day's low. The 50 MA to me looks like a ton of support. I think at the very least it will be a day trade for a right or right out trade if it were to ever get that low on the first go round. Amazon, this is another one. This was up early yesterday on a gap. A lot of people were very excited about it. My response to that was sort of like silly rabbit, tricks are for kids. They're not going to gap this thing over, not on this tape. A certain tape, like I said, being able to read tapes. And this wound up failing miserably and it's back below the 50 MA. This to me looks like it's building a lot of tension. If I had my druthers, it would be a move down into earnings and then set up for long. I don't necessarily know that they're going to make it that easy. But until you can get a sustainable move and close now over, you just, by the way, had the 50 cross through the 100, which is, I don't know, a bear type of signal. I really would need to see this thing make a higher high and close now above the 50 and maybe even the 100 MA at this point. I want to see the pattern sort of swing. I don't think that the high, the top, is in necessarily for Amazon, but I don't see anything technically here that needs me to get into it. Earnings are on January 26th. There's a lot of runway between here and there. So that's it. I need to see a close and some confirmation above those major moving averages before I get excited. Like I said, anecdotally, I've been seeing a heck of a lot of Amazon boxes, and just on my own buying, it probably will be a beat for the season. I've been loading up on stuff on Amazon. I don't mean the stock. I mean, like, buying things. By the way, they have great deals on vitamins for anyone who's interested if you're a Prime member. Tesla. So we have a situation in Tesla. Yes, it was a look above and fail above the 50 MA. Very astute observation. Tesla broke down from the 200 MA and it cut through it pretty nicely. Now it's back on it. So I'll keep it simple. I think that the stock is going to have a hard time sustaining. It ran a lot, first of all, so it had moved a lot up to the 200 MA. What I would have liked to have seen was it to have consolidated a little bit under and then gone, and I would have believed it a little bit more. But as long as you're north of the 200 MA, you could be long. If you're back below it, you'd want to either be short or flat. I'll keep it that simple. The 200 MA is sort of like the door test from Bronx Tale, those of you who are movie fans, it's the door test kid. So the 200 MA is the big deal for Tesla. I think it's also got to get a capital raise out of its way early next year, so that could mark the bottom for that stock. Mobileye today, for the first time in a long time, showed some signs of life. I think they had some kind of special deal. Today was a gap and go above the downtrend, so that could technically be a professional gap. If there were an early pullback tomorrow morning, I'm down with buying the 50 MA for a right or right out trade and then using the stop below today's low. The best scenario tomorrow could be like a doji bar, and then over it the next day, I would be playing for a long. But I like Mobileye versus the 50 MA. If it gets back below the 50, today was probably just an aberration. So keep it simple, stupid with Mobileye. I did Amazon or any. I'm going to default to my Under Armour analysis from the weekend review video just to save time because it hasn't changed. Check that out. Mind you, retailers are not in the best of seasons right now. They tend to peak around Black Friday. Kate Spade is another one. Wow, that thing was up. I actually had a resting buy order in today at the 50 MA. It only pulled back to the 100 and then the thing just ripped. I'm fine with being long versus today's low of day. That could be a good stop. I've been watching this one for a while. I'm really actually pissed I didn't get into this. But yeah, that's the story with Kate Spade. You can now use the low of day today as a stop. Chipotle, I've actually started eating there again. I'm probably a little early with that. Too much tax loss selling. I think this is one we'll revisit next year. It's failed miserably at interesting levels. It's now making lower highs and higher lows. Wait for that pennant to snap and go with it. If you snap the trend, the pennant to the downside, you'll probably revisit the old all-time low and maybe even lower. If you could snap the down, the pennant to the upside, then I think you fill up the range probably close to 420. Sure, there's a lot of 420 users who go to Chipotle. No pun intended, although there really was a pun intended. Gold. It got basically the 78.6. It's bouncing. It's above the 20 MA. This probably could rally to the 50 MA maybe. This really, wow, it got really overdone. I can't say that you have great entry here because it's rallied $4, the GLD I'm talking about. But if you can get back up over the 110.98, which was really the big dump bar, you know what? I'm starting to warm a little bit to this, the fact that it's over the 10-day. I actually, the other day, and I don't know what got me, what really motivated me, but I took a stab in silver, SLV, and it turned out to be like pretty much the lows. It's also over the 10-day. I actually prefer silver to gold because I think that the downside to silver is limited to like 14. I have some reasons on that level. I don't really want to get into them right now because it'll take up time. But if there is a levered move, initially gold will lead, but when the real Momo starts coming in the chasing, the silver is really what takes off. So I actually prefer silver to gold, but yep, GDX I was waiting for patiently down in the 15s with actually some decent size. There were some old reference lows there and some so on and so forth. So someone asked me this today. I said I thought it could get up to the 50. It pretty much is there. This now needs to break trend. You've had 1 wave, 2 waves, 3 waves, 4 waves kind of down. I was hoping for a 5th wave. We may still get it. But if you can clear and hold the 50 MA, I think it's going to repair and probably has room to the 100 and 200 MA. If it stalls at the 50, it's just going to go lower again. So that's the deal with gold and GDX. The TLT, the other day I talked about playing it long. I promptly was stopped out, and then I took a stab at it again, and now it's working. Yeah, I think this could see the 50 MA, which is roughly the 2009 crash peak at 123. Eventually, I don't know if this will get back up to fill the gap. Believe it or not, a full gap fill is right at the 50% fib at 130. We'll have to see how that plays out. But I'm long via risk reversal. The play I have, the first time I tried this was with shares, which was probably not the smartest attempt, although now I'm short in February the 113 puts and long the 118, 123 call spread. It's working. If we were to get back below, where would I stop out on this? I think if we were to, because I have good trade location now, and I really want to try and hold this, the 10-day MA. If we can hold the 10-day, I'll stay long. If we get back below it, what's TLT at that point? I don't even want to know about it. It could probably get back down to the 114, 115 at that point. Alrighty, we talked about TLT. Apple. Let's talk about Apple quickly. I actually had taken profits in Apple, and now I'm back in it actually with a similar risk reversal call spread. The same situation here. I was very close to a stop out today, but it didn't stop me out. If we lose 116.20, I am outie 5,000, and we'll probably revisit that down at the 50 MA. So it's F or walk here with Apple, really also on the 10-day MA. If we lose that, I think we would see the 20 MA kind of quickly. So I'm using yesterday, not today's range, but the day before's range. So anything below 1620, and I am out of there. Above the high, above 1802, I would actually probably, as crazy as this sounds, be looking to add, because we've now spent a lot of time playing around at these levels, and we could maybe see a channel high that I've drawn in that I'll show in the weekend review video up to 125. I discussed Tesla before. Someone who just asked if you missed it, rewatch the video. It'll be on my YouTube channel shortly after this broadcast. I think we covered a good... Oh, one more thing, the dollar. This is a very, very key area for the dollar. This is basically in a bull flag mode. Today was a day that will live in infamy forever. Now, yeah, I've been watching the show, The Man in the High Castle, so I'm all about World War II lately. We're in a consolidation range here. It lost the 10-day today. You know what I think about losing 10 days. I think we could see 20 days. That would be good for the gold trade. That would be a retest into the 102s if that were to happen, and it would also be a trend touch and an old channel touch. It'd probably be an area to buy. I think you could even initiate a row short below 102.5. That area for a quickie for maybe like 50 cents or so. But above today's high, it'll probably go higher. So I'm liking playing basically against kind of today's range for the most part. Pullback in the dollar, by the way, would be good for the market. I think it would alleviate some of the pressure of the negativity there. So I think that is going to be that. Oh, Facebook. Let's talk about Facebook. I got a lot of people asking about that one. So I think Facebook's under pressure for a few reasons. The first and foremost one is that in their last earnings report, they didn't, and we're going to end on Facebook here, they lowered their growth forecast, basically. They said things were slowing. That is not what you need when you're at all-time highs. There is some good news and there is some bad news for Facebook. One is that it hasn't really lost the double lows yet, and it's sort of meandering around some key levels. Below 117.59 is a little vulnerable. I showed in the weekend review video my same analysis again. Below 124.61, that is on the weekly, the bounce candle high. If you can't get above that, the stock remains vulnerable. So lowering the growth forecast was one. Two was the rotation out of FANG into the kind of the materials and the industrials based on the Trump trade, as they call it. And the third that I don't think most people realize is that Snapchat is coming public in early 2017, and I think portfolio managers are making room in their social space for that. So it has a few things going against it. I'm curious to see how this will do on the next earnings report. I'll tell you this, if Facebook muffs it on the next earnings report, like if it's down on that, I would say it's probably safe to say the stock has peaked, and I don't even want to get people too cray-cray about where the thing could go. We'll cover that when that comes to, but the projections could be significantly lower. So next earnings report is really, really do or die for them. I think if it's good, they'll fill the gap back higher and fill up the earnings gap. If it's bad, the stock is going to be in some big trouble. So we'll revisit that. We have until 125. So a little over almost a month. So we'll revisit Facebook when we get there. The best scenario for Facebook for a write or write out setup for earnings would be for it to either rally up and close the gap to short, or for it to dump and panic to set up for a long to buy. If it just meanders here, we're going to have to use the consolidation range as the guide, and we would be long then on a break of 124.61 or short below 113.55. So I kind of still like that setup before or after earnings, even more so after. Anyhow, that's my story. I'm sticking to it. If you missed this video or want to watch it again, you can see it on my YouTube channel. That's Justin Pulitzer Trades. Thank you. I appreciate the recognition of my call out on TV. By the way, on Fast Money, they had called me out because I had told them that I thought they were all holding hands and basically telling everyone it was rah, 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 buy, 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 and the market's gone down ever since. So, they had a good laugh, but it probably cost some viewers some money. And, I was very, very bullish until we reached some of my upper targets. I don't know anyone who was talking about 138 in IWM. We got it. And, when I reach my targets, it's okay to sell. It's okay. I promise. It's okay. It's like petting a little pet. It's okay, little bull. You can sell a little bit at the channel high. Anyway, that's that. I hope everyone had a great year. If you didn't, it's okay. We'll get them next year. Happy New Year to everybody. Happy holidays. The markets, don't worry, will be there on January 2nd. If you missed this video or want to watch it again, you can see it on my YouTube channel, which is Justin Pulitzer Trades. And if you're not following me on Twitter, my handle is @JustinPulitzer. Have a great New Year's, a great rest of the trading week, and I'll see you on the flip side in 2017. Have a great one, everybody. Cheers.